Good afternoon again. Greetings from the IMC Chamber of Commerce and Industry. The IMC Chamber is a 117-year-old institution headquartered in Mumbai. Churchgate. It's an iconic institution, iconic building, more than a, and the IMC and its membership have contributed to the economic growth of this country. IMC and its members have contributed to enormous amount of wealth creation over the last 100 years. Okay, and therefore it's an extremely important partnership between IMC and MCX. And more important, let me also mention, IMC is a SEBI accredited training institution for commodity derivatives. And I'm so proud to say, and all of us are so proud to recognize and acknowledge this distinction, that in India, IMC is the only chamber of commerce with this distinction of having accredited by SEBI as a commodity derivatives training institution. Okay, and therefore I'm quite proud of saying this as often as possible. Now today we have assembled here to discuss the Commodity Fundamental Forum. This is base metals. We had the bullion event last month, and earlier we had the agriculture commodities, cotton and palm oil, etc. So this is a cycle which goes on. Specifically, IMC and MCX have had a very strong bonding and relationship over the last several years. IMC has always supported MCX's activities. And as all of us know, MCX is India's largest commodity derivatives exchange. It is and by far the largest commodity derivatives exchange. It specializes in metals and in energy, and in metals both in bullion, that is precious metals, and of course in industrial metals or base metals. Extremely important. And therefore, these two institutions have come together, IMC and MCX, to deepen and widen the commodity derivatives market. And we are in this together. Journey will continue. And then hopefully, I think we will, our education program, our knowledge series, our awareness programs will try and attract more and more participants into the mainstream of risk management. So this and therefore we need to show two slides which are mandated by SEBI. And Bharti, will you show those two slides, please? Bharti, are you sharing screen?
Yes,
Yeah, okay,
yes,
yeah,
sir.
okay, ma'am. Oh. So this is a disclaimer by both IMC and MCX that the speakers here are sharing their views. It is not necessary that the views expressed in this event represent the views of the organizations. Okay, I think that's very important. But we have absolutely top class speakers who have in-depth knowledge and experience in this field, and therefore this is going to be quite enriching. Yet we need to issue this disclaimer. The next one. Yeah, this is by SEBI. In fact, SEBI is very keen to deepen and widen the commodity derivative market, which is extremely it's important, because I've always believed India's economic growth is going to be commodity intensive. Over the next 20, 25, 30 years, we are going to grow. We are in an expansionary phase. and commodities are going to play a very critical role in India's economic growth. And therefore, investor awareness is extremely important. And therefore, I think I would request the Unlock the Wealth of Knowledge. SEBI has an investor website, and I'm sure you will have a lot of information to study there and to create awareness for yourself. So I think this is fine. I'll now go, Bharti, if you withdraw this, I will start screen sharing. I will go to my presentation, which is here. Share. Here it goes. Slideshow. There is it. Slideshow 1. Okay. Let me start from the beginning. Again, as I said, it says IMC MCX webinar. We do these webinars from time to time. We cover various commodities of interest to MCX, whether it is agriculture or precious metals, base metals, energy products, etc. Today we are looking at base metals. We will look at the market outlook for 2024. And here is my presentation. Now, base metals, in my view, are absolutely critical for the country's economic growth. There's a strong positive correlation between economic growth and metals consumption, particularly industrial metals and base metals. In fact, copper, for example, is called a growth commodity. It's called a growth metal, okay? Because the consumption of copper, a demand for copper, use of copper and steel, for example, these are called growth metals. Rises, the demand for these metals rises with economic growth. So there are 4 or in fact 6 basic base metals that we'll be looking at today: aluminum, copper, nickel, zinc, lead, and tin. These base metals are very substantially used in 3 major, I would say, sectors or verticals. One is construction. When I say construction, obviously it covers housing, it covers industrial units, it covers infrastructure. And our country, we are going to be spending not less than $1 trillion every 5 years over the next 20 years, because we are going to be building a whole lot of we have very large infrastructure programs in our country. For example, we are going to be building, and we're witnessing this, roads, bridges, airports, seaports, urban infrastructure, housing. At any given point of time, India faces a shortage of at least 50 million dwelling houses. Okay, you can say, you can imagine how booming the housing sector is going to be over the next 20 or 25 years. For construction, which covers commercial construction, residential, and infrastructure construction, like roads, bridges, and airports, seaports, etc., is a major user of metals. And as I said earlier, India's economic growth is going to be very substantially commodity driven, commodity intensive, particularly metals intensive. Then we come to energy. We, as you know, are in a period of energy transition. We are moving from polluting fossil fuels like crude oil and gas and coal to we're transiting to non-polluting renewable energy like solar power, wind power, biofuels, etc., etc. And then therefore, there'll be enormous demand for metals in this energy transition. For example, wind turbines, we need power grids, we need solar panels, etc. Therefore, energy sector, like the construction sector, energy sector is going to drive metals demand in our country. The third one is called mobility. Mobility is movement. And when we talk of mobility, we have to talk about roadways, railways, airways, and seaways or waterways. Okay. And in all this, there'll be massive use of metals, particularly base metals. And now we also have electric vehicles. We'll be gradually moving away from ICE cars, like internal combustion engine cars, to electric vehicles, and the trend has already started. And EVs are highly metals intensive. Okay, and therefore each one of the sectors, whether it's construction, energy, or mobility, is highly metals intensive. So that will actually drive demand for metals in our country, base metals and industrial metals. And as I said earlier again, positive correlation between economic growth and base metals demand. And there will be enormous amount of global trade in these metals, because not all countries have all the resources. God has not given all the resources to all the countries, and therefore resources are unevenly distributed globally. Certain countries have more richer resources. For example, Chile and Peru, for example, are big producers of copper, for instance. Okay, and therefore there will be trade. There will essentially be trade in base metals across the world. And also mining projects take a long time. You need to invest heavily, and it has a long gestation period to start showing results. And therefore, these are factors that will actually affect supplies. So there are multiple factors which will affect the metals market, commodity markets in general, and metals market in particular. For example, economic growth will be a factor that will impact or drive the metal market. Geopolitical developments will drive the metals market. Monetary policy will drive the metals market. When there is more liquidity, there'll be more money, money in the hands of people, more money for investment at lower interest rates, etc. So for monetary policy will drive. Then you have currency factor, which will decide the value of import or export. Particularly the dollar, value of the dollar, and of course weather conditions. You may be wondering how weather conditions can impact metal market. They do. I think natural disasters have often impacted production of metal. Therefore, these are multiple drivers that impact the metals market, and we need to track these multiple drivers to get a sense of the direction of the market. Okay. Now, like all commodity markets, the metals market is also highly volatile. The prices keep fluctuating. And why are the prices fluctuating? Again, that is caused by several factors. One, of course, we talked about natural disasters. We've seen in many mining areas, for example, floods. We have seen earthquake. We have seen labor action. Every year, the mine workers actually negotiate with the owners of the mines, and they often go on strike also. Then you also have policy changes by the government. For example, protectionism. Countries practice protectionism, not allow liberal export of certain metals, and sanctions. For example, there's a sanction now on Russia, and therefore there is a certain impact of that on the aluminium market, as it were. And then another driver is the exchange-based inventory. People are all tracking all the time inventory levels at the exchanges, and that also gives you a sense of the market direction. Or what is important for us to understand when there is price volatility? Why are the prices volatile? Usually, this is not a rule, but usually it is a change in supplies that leads to price volatility or price fluctuation. Demand usually is quite steady. I think it'll just keep growing steadily. But supplies are rather uncertain because of those various factors that we talked about: natural disasters, labor action, policy changes, etc., etc. And therefore, we need to track supplies, and supplies in some way drive the market volatility. And therefore, volatile prices, high amount of price fluctuation in the base metals market means that the value chain participants have got to manage their risk. Otherwise, manage their price risk. Otherwise, they'll end up losing money. It can hurt that top line and bottom line, etc. And then scientifically tested tools are available for price risk management. And therefore, today we are going to be discussing base metals from a fundamental perspective. Okay, and this fundamental perspective is important. When we talk of fundamental perspective, we're looking at production, we're looking at opening stock, then we look at production, then we look at import, then we look at domestic consumption, we look at export, we look at closing stock, etc. All these numbers are very, very important from a fundamental analysis point of view. And that's why we call this the commodity fundamental forum. Okay. And then there is another side to it, which is called a technical analysis. Therefore, technical analysis will be based on charts, etc., etc. Therefore, today we'll be looking at the fundamentals. Now, let's discuss outlook for base metals 2024. Okay, the market, I see that for base metals, 2024 will be a year of two halves. Okay. Now, why am I saying this? In 23, last year, those of you who had tracked the base metals market, you all know there were concerns over supplies when the war between Russia and Ukraine started. There were concerns over supplies, but in 23, that those concerns eased quite substantially. Okay, and we all know that. But at the same time, while supply concerns reduced or eased, demand concerns came to the fore. Why did the demand concern come to the fore? You had aggressive rate hikes by all the central bankers under the leadership of the US Federal Reserve. You had very high levels of inflation. Then you had the fear of slowdown, and the slowdown now we know is quite real. And China's own post-COVID recovery, I think very tepid recovery. They did recover, but the recovery was not as robust as it was expected. And China is the country, the market we need to track very closely, because China is a mover and shaker of the global base metals and industrial metals market. Very, very important. It accounts for a very large share of production, consumption, and trade. And China faced this challenge last year primarily because they had some challenges in the property market. And I'm sure you all know about that Evergrande and other issues that China's property market faced. So that's the situation. Therefore, the in 23, the concerns over supplies eased substantially, but concerns over demand came to the fore. So now what should we how do we look at 2024? My own belief is that a large part of the slowdown in the global economy, whether it is China or Europe or the US, I think is already priced in. The price reflects already the slowdown. And I can very clearly see that the aggressive rate hikes that we saw in 23, monetary policy has always a lagged effect. Okay, therefore we had aggressive rate hikes in 2023, and that lagged effect of that monetary policy and rate hike is actually now kicking in. That effect is kicking in. That is why we have high levels of inflation, but inflation is now gradually declining. Now, the US and Eurozone are staring at a mild recession. And the US, because of that, the US wants to certainly avoid a severe recession. And therefore, I think the US Federal Reserve has kind of pivoted the interest rate hike. You've seen in the last few months, there has not been any interest rate hike. And I don't expect any further rate hikes at all. And there is a possibility of a rate cut, but whether the rate cut will happen in May or June or July, we don't know, because the US economy is still doing reasonably well despite high inflation and high interest rate. Therefore, rate cut will start. Whether it's May, June, July will be data based. We don't really know, but rate cut will happen. That's the belief amongst all the economists. And once that kicks in, once the rate cut cycle starts, then of course the dollar will weaken. That's very important for us. Now, again, that's the first half. The second half, there is at least my own expectation is that the US and Eurozone will gradually come out of recession. When interest rates are down, when liquidity improves, there'll be a lot more interest in the market, lot more investment, lot more trade that will happen, and therefore that will lead to greater economic activity, and both US and Eurozone will slowly come out of recession in the second half of the year, possibly in the last quarter of the year. I also expect that the activities in China is slowing down very clearly. China's for 2023, the GDP growth target was 5.5%, but it's ending up less than 5%. And therefore, my own sense is Chinese government is very keen to prop the property market and keen to support its economy. Therefore, I won't be surprised if further stimulus packages are on the way to support Chinese economic activity. All that is going to prop up the commodity markets in general, and certainly the metals market. Then let me talk about so the first half this year, demand concerns to make will actually rule the market. It will subdue the market, whereas in second half, rate cut and accelerated activities will actually boost the market. And very clearly, as I said earlier, Chinese government has shown a very clear intent to prop up the slowing economy, particularly the construction sector, which is a big user of base metals. So I think with this, I will I'll stop. But let me also make a few more sentences. So in 23, supply growth was better than expected. By most for most metals, supply growth was better, and that is what resulted in a rise in inventory or stocks in 23. But in my view, the supply growth in 24 will be a lot more modest than it was in 23. Or at the same time, demand growth will rebound due to green transition. We are all the energy transition. I'm sure all of us know. Green transition will push demand for base metals up. My own belief is copper is the metal that will benefit the most, as in my view, supply growth will be constricted, supply growth will be limited, and therefore copper has a slightly better upside potential for prices. But supply growth in aluminium, zinc, and nickel will be a lot more robust, a robust increase in supply growth, which will lead to a very muted price rise for these commodities. So this is my take on the fundamentals of the base metals market. Good luck. Thank you very much. But I must issue a disclaimer. I am not a trader. I don't hold any trading position anywhere in any commodity, either in the physical market or in the derivatives market. I'm a student of this market, and I track these and share my thoughts with no trading interest whatsoever. So I will stop sharing screen at this point of time and invite our young friend Sandeep Daga. Sandeep is a well-known expert in the metals market. He's a regular speaker in many of the conferences, both within the country and outside. I'm sure Sandeep has a lot of insights. He'll be able to bring greater insights into the base metals market. And over to you, Sandeep.
Thank you so much, sir. You've set a beautiful backdrop of the fundamental picture of metals, and I think you've covered the whole variety of factors that affect commodity markets, metal markets specifically, and everything that's going to drive the price in 2024. I am going to take the baton from you and move further from here, and just building on the thoughts that you have seeded. So you can just blow up this
Go to
presentation,
slideshow.
Bharti. Yeah.
Go to slideshow and you'll be there. Acha, who's doing?
I think maybe
Bharti
it's
is
going
doing.
to a,
Bharti, slideshow.
do you have a dual screen? Maybe it's going to another screen then.
Bharti, go to slideshow on top. On top.
Go to the first slide and press F5.
Awesome.
That's
Yeah, perfect. Here it goes. Yeah.
Go to the first one. Okay. Just go back. Go back, please. That's it. Yeah. Thank you very much. So, as Mr. Chandrasekhar talked about, there are variety of factors that affect metals, and in this fundamental forum, we're going to talk about all these factors. Now, as a consultant, I talk to many of my clients, and the clients tell me sometimes that the metals are driven by the US Fed interest rate policy, sometimes by how dollar is moving, sometimes by the stock report as to how much is the inventory left in LME and Shanghai warehouses, and sometimes driven by the Chinese data. Nowadays, we are seeing the Chinese equity is falling lower to almost the lowest in 9 years. Sometimes that affected. So there are a variety of factors. The question comes up as to what, as an investor, as a businessman, we should look at. How do we analyze this whole commodity space? How do we simplify this complexity? How do we look at the big picture? And I would like to take up from where Mr. Chandrasekhar left in terms of the big picture for commodities. So let's go back. Can you go to the next slide, please? Can you move to the next slide, please? Yeah. So the metals are made up of many complex factors, but if you want to look at the big picture of metals, it is largely the macro picture, the economic growth picture. It could be the global growth picture, or it could be the Chinese growth picture, which is nearly 60% of the commodities world or the metals world as such. Can you just press the arrow button, please? So the first thing is that the economic growth trajectory of the world sets up the primary trend. And let me take an example here. In 2023, we saw equities soaring up in US, in Europe, in India, yet metals were falling. And the reason was that the growth was slowing in China. So far as the macroeconomic picture is showing a direction, the large move in commodities will happen in that direction. The second point is micro. It's not, can you just press the arrow button, please? It's not, that's fine. So it's not just the macro picture that sets up the commodities, it's the micro picture as well. So within the framework that the macro picture really sets up, the metals can move within that picture in different directions. For example, last year, copper was almost unmoved from Jan 23 to December 23. Copper moved just 1%, while nickel, aluminum, zinc, they fell around 25 to 30%. Why did that happen? Is because of the demand supply, specific demand supply factors of that commodities. So that means the macro picture said that metals cannot move too high because of the worsening macroclimate, especially in China. But the micro picture said that a few metals will underperform some other metals. So that's the micro picture. That's the next level picture. And if you want to dive further deeper, you look at the money factors. So if we know that in today's world, the currency available, the money available is far bigger than the economy. And therefore, this money really moves market very, very swiftly. But let's remember, the money cannot move the market beyond the macroeconomic picture. For example, oil prices has been steady around $70 to $80, despite US economy doing so good and the consumption of oil really going up, the geopolitical risks happening, all of this. Despite that, oil is very, very stable because we know that just the money cannot really move everything. The investors have to look at the macro picture, micro picture, and then the valuation games come in. That is driven by the dollar, the movement in dollar and interest rates. And then comes the bulls and bears. Bulls and bears are no one but they are just players in the market who play the top three stories, the macro, micro, and money stories. Sometimes they overplay the story, but they do not create the story. And therefore, if something is bullish or bearish, it's because the macro, micro, and money picture is supporting it. Okay. And then comes the technical part. Technical charts may set the trend, may not set the trend, but they will depict the trend that is set by the top four factors. And they can be used for timing, for entering and exiting the commodities markets as such. So I'm a firm believer that the macro and micro picture is the biggest mover in the longer term for commodities. In short term, there are all these factors like money, positioning, and technical that really matters. Next slide, please. So in order to prove my point, let me show you a picture of LME zinc prices. Now, these are the zinc prices starting from 2018 to 2024. As we all know that after the COVID crisis, the metal prices saw an amazing recovery from March 2020 to March 2022. The prices recovered very, very sharply. And during this period, we saw an energy crisis in Europe. Nightstar cut their output. In many of these smelters, Glencore cut their output because the Russian gas supply to Europe was curtailed, and because of which the prices moved up further. And then there was a Russia-Ukraine war in February 2022, and the prices moved up further. And zinc moved to an almost new record high at near $5,000. But yet, what happened after May 2022? The same supply side stories of closure of smelters, closure of mines continued. So let's say in August, September 2022, Budel smelter was closed down, and then Obi smelter was closed down. The mines like Tara and Jaguar mines were closed down because of low prices, but the prices kept falling. As latest as January 2024, this month, the Budel smelter, which is nearly 315,000 tons per annum, that has been closed down by Nightstar, and the prices have not moved at all. Why? Because the demand is the biggest trend sector for commodities. If demand is good, then every supply factor will move it. But if demand is not good, supply news do not matter. Let me take it up with another slide about copper. Let's move to the next one, please. We saw the same story for copper. So we saw the LME inventories falling down to a multi-year low in May 2021. And then Goldman Sachs, Trafigura, and almost a big school of thought was that we are entering into a super cycle for copper. And copper prices go to $10,000, $15,000, $20,000, $25,000 because the world is running out of mines. And then came Russia-Ukraine war, and people got even more scared about the supplies available for copper. But what happened from the second quarter of 2022 was completely inverse. The demand slowed. And because of the slowdown of the demand, all the supply side stories, supply curtailment stories stopped moving the prices. So let's say in July 23, we had the news that Codelco is at the risk of insolvency. Had this news come in 2021 and 22, copper could have gone to $12,000, $13,000. Cobre Panama, which produces nearly 1.5% of the world copper, was permanently closed down after people's protest. Copper premium went to a 13-month high in the last quarter. Shanghai stocks hit a 14-year low, and yet prices are not rising to the level that the super cyclists have been talking about. Reason? Demand outlook is not that good. So my whole point is that in the big picture, it's just the demand that drives the prices, and supply side just kind of exacerbate the move. It makes the move accentuated. Can we get the presentation again, please? We lost the presentation slide. Bharti, can we get the presentation, please?
Sandeep, if you have the presentation, you can upload, no? Okay, I think it's there.
That's fine. That's fine. Okay. All right. Okay. Perfect. Okay. Let's move to the next slide, please. So that's the macro picture. Can we move to the next slide, please? Just arrow button. Okay. Now, in the continuation of the macro picture, I have this. This is the global manufacturing PMI. Historically, this PMI data has been very closely correlated with the metal prices. When in 2021 and 22, the PMI was positive, metal prices were riding higher. But from September 22, this turned negative. And let me put this note to everybody that this PMI, the global manufacturing PMI, which is the state of the industrial sector all over the world, a consolidated picture, shows that the contraction has been happening for 16 consecutive months. And this is the longest period of contraction that we have seen. Not even in 2020 and 2009 of the credit crisis and the COVID crisis, we saw such a long period of contraction. And this contraction really means that the metal prices cannot really rise too much. As Mr. Chandrasekhar also said, that the demand story does not look very, very good all over the world. Let's go to the next picture, please. Next slide. Next slide. Okay. Now, in order to just emphasize this point, the previous one, please. Go to the previous one. Yeah. So this is the GDP of different economies. We saw that 2021, all the economies recovered very, very fast. 22 and then 23, it was a fantastic growth year for the world. As you can see, these are the forecasts from World Bank, and as you can see, the US economy will be slowing down from 2.5 to 1.6%. That's the forecast. EU economy will move from 0.4 to 0.7%. I'm not sure whether they would. The state of the economy is not really that good, but still 0.7% is below 1%, almost a stagnancy in European economy. The Chinese economy, which is nearly 60% of the metals world, is going to slow from 5.2 to 4.5%. This is a substantial slowdown. As Mr. Chandrasekhar says, China is not willing to add more stimulus to its economy after having stabilized its economy in the last year. Japanese economy growth rate is going to halve from 1.8 to 0.9%. India is going to be the shiny star, moving from 6.3 to 6.4. Yet, India in the overall base metal global consumption is just about 6%. So it may not move the global prices that much. So as you can see, the global growth rate of the major economies is going to slow down in a synchronized way for the first time since 2009. And the growth rate is going to be the slowest outside a crisis year in the last 2 decades. This poses not so happy picture for the metals demand going forward. Let me take this in the next slide. So this is a little cluttered, but this is a beautiful depiction of link between global GDP and the metal prices. The global GDP, whenever it slows down or it slows down for 3 consecutive years, the metal prices starts to decelerate. We saw this in 2007-8, and then we saw this in 2012, 2017, 18, 19. We saw this. 2024 will be that year when we would see the 4th consecutive year of slowdown in the global economy, obviously coming from a high base, but the growth slowdown is going to be, the growth is going to be the slowest since 2008. So if history is any guide, that means the price changes for the metals is going to be negative, although they're coming from a very low base. They already fell last year. These are the numbers for copper prices. But if the economy really slows in the way the World Bank is forecasting, there are good chances that copper also underperforms this year. Let's go to the next slide, please. So industrial demand has been the traditional source of demand for the metals. Green energy is the newest one. Especially a few metals like copper and nickel are consumed heavily in the green energy consumptions. What we saw in 2023 was a remarkable shift in terms of adoption of green energy all over the world. And this was led by China. So if I can tell you the numbers, electric vehicle sales in the world grew by 30% in 2023. And out of that, 70% came from China. So if I give you the numbers, nearly 13.5 million vehicles were sold in the last year, out of which 9.5 million were sold within China itself. China has an incentive policy for its people, and they bought nearly 40% of all the cars bought in the last year were electric vehicles. This compares with nearly 6% in US. So China adopted electric vehicles in a big way last year. Also, because electric vehicles is going to increase the demand for electricity in the country, and also as a part of the green energy initiative, China added nearly 160 gigawatt of renewable power in the last year. And this is almost equal to the total renewable power capacity in India. So they added one India in 1 year. And because of which, a lot of consumption of copper and aluminum happened. So if we can just do a ballpark calculation of this, the copper consumption in electrical vehicles rose by 1 million tons, which is nearly 4% of the global consumption of copper. Although it looks like a small number, but it's huge because it's creating a completely incremental new demand for copper, which is absorbing the slowdown that's happening in the housing market all over the world, and especially in China. Similarly, aluminum consumption went up by 1.5 million tons because it was used in automobiles that were sold all over the world in the form of electric vehicles. However, what China did last year was a compulsion on itself, because the property market was slowing down and it had to find ways to balance its economy. And that's the reason government gave a lot of push to the electric vehicles and solar investments. However, this is going to slow because China is far ahead of its target, number one, in terms of solar capacity addition. Solar chip prices have crashed almost in China. Electric vehicles, China has nearly 10 million vehicles of additional capacity available. So whatever China is producing, it has double of that capacity available. And because of which electric vehicles margins are coming down. So makers are in a price price cuts and
demand push,
which is becoming very hard for the electric vehicles companies in China to make money. So because of all this, my guess is that green energy initiative is going to continue. However, the adoption is going to slow down next year. Go to the next slide, please. So let's look at the demand, supply, all of this together. How does the picture really set up? Now, ICSG is an independent corporate study group based in Lisbon, and it does analysis of the production and the consumption trends all over the world. In 2022, copper was in a deficit of nearly 314,000 tons. In 23, it expected to be slight surplus. In 2024, ICSG forecasts a surplus to be nearly 500,000 tons. This forecast was done in last October, and this could be revised in April this year. However, the surplus really shows that despite the long-term worries for copper supplies, in the near term, copper is enough to meet the demand for this year. Similarly for copper, similarly for aluminium, the 2023 and 2024 will see surplus. The demand for aluminium in US and Europe is already contracting by 4 to 5%. In China, the growth is still steady about 2 to 3%. And therefore, we are seeing some kind of deficit in China, but surplus in the rest of the world type of story. In zinc, which is largely used in the construction industry and the automobile industry, we are seeing a story of surplus there as well. And this is the forecast from ILZSG, which is another independent body which does analysis of demand and supply. Lead is also going to be in surplus this year in 2024. All these numbers are in 1,000 metric tons. Let's go to the next slide, please. So let me focus on the US dollar. This is something that I have a contrarian view to the bigger market picture. Now, this is the US dollar index since 2011. And we can see that despite the US Fed continuously printing money year after year, crisis after crisis, the dollar, instead of sinking down, has been strengthening continuously. So between 2011 and now, the US balance sheet, US Fed money supply has grown from $3 trillion to almost $8.5 trillion. So they have printed nearly $5 trillion extra dollars into the market. And yet, dollar has strengthened from 72 to almost 102. Can you just press the arrow button, please, so that I can see the animation one by one? So dollar entered a bull cycle in 2011. And then the next, please. And despite a lot of corrections that has been happening, dollar continues to remain strong and it's been holding up, trending up slowly and gradually year after year. Next. These corrections, and it's very interesting, is that these corrections have been happening and lasting for nearly 1.25 years. So in 2013, 14, in 2015, 16, 2017, 18, we have seen these corrections of dollar coming from a very elevated level to down. And that has been helping commodities to push up. But the big picture for dollar continues to go up and up. Next, please. In the month of January, we have seen the 462 days. I don't know why this mystical number comes up, but nearly 462 days of consolidation in dollar is over. That means if history repeats, dollar is ready to push up. Now, let me give you a fundamental story. This is kind of more chart-based historical story. The fundamental story why dollar still has room to move up is number one, that people have put a very, very heavy bets against US dollar, almost historic high bets that US economy is going to go down and rate cuts going to start sometimes in March. Investors are pricing in 6 to 7 rate cuts this year, although Fed is saying 3 rate cuts. So this room for disappointment for investors. That's one. The second story is that the US economy is still very, very robust, something that Mr. Chandrasekhar also touched upon, and I entirely agree. If you look at US job data, if you look at US retail sales data, if you look at US core inflation data, all of this suggests that recession or soft landing or slowdown is nowhere in sight at the moment. That means, although it's possible that dollar comes under pressure because of unsustainable debt that the US economy has created, but in the short term, the kind of positioning that investors have done against the dollar, that provides a room for surprise rally in those dollars. Next slide, please. This is the positioning factor, the bull-bear ratio. So the ratio is created around 1. Anything above 1 means the bulls are dominant, and below 1 is the bears are dominant. As you can see that over 2023, the ratio has been continuously slipping lower. Copper and zinc are still in a positive territory, but aluminum, lead, tin, and nickel are in the hands of the bears. So the bears are holding on to this a dominant position in these metals. Next slide, please. So to conclude, the global growth slowdown that is expected this year may not allow metals to recover, despite having sold off quite heavily in the last 1.5 years. China has stabilized its property market, which is the biggest commodity consumer sector or metal consumer sector. However, having stabilized its market, it may refrain from doing more fiscal stimulus, and because of which new demand creation should not be expected from the sector. China has invested heavily in the last year in the green energy sector. They will continue to do so, but there is no need for such an aggressive push given that the property market has stabilized. US consumers and the job market is astonishingly strong, and therefore investors may have to digest some disappointment on the Fed rate cut, and that could keep dollar strong in the first half of this year. So in the best case scenario, I think the metals may remain unchanged. So the next one, I think that's the last slide. So thank you very much. We have our app called Metal Intelligence Center, where we provide a lot of fundamental analysis and information about the markets, about the base metal industry, global industry, the demand supply picture. If you are interested, you can have a look at this. Thank you very much, everybody.
Oh, thank you very much, Sandeep. Excellent presentation as always. Very interesting, very insightful, very knowledgeable. Thank you very much once again. Of course, I just want to intervene and talk about copper. You mentioned the last International Copper Study Group you saw was October, right? Yesterday, they issued the latest for November. I just want to share offline. Of course, I'll forward that that note or that mail to you. According to the International Copper Study Group, only for information, okay, that as of November, production of refined copper was 2.258 million tons. Usage of refined copper was higher at 2.377 million tons. Therefore, the balance was minus 1,19,000. So that's it. Therefore, the market is actually in a small deficit at this point of time. The second point is, again, my take, I mean, every analyst has his own take, is that next year demand growth will be higher than supply growth, because I'm also seeing problems in the mining sector in South America. Therefore, supplies, there is an uncertainty relating to supply. But anyway, and that will obviously have an impact on the market. But wonderful. Thank you very much. Absolutely insightful. I'm now going to invite, of course, the Chittaranjan will speak about the exchange perspective, risk management. But before that, very quickly, let me invite India's foremost, I would call technical analyst, currency market expert, commodity market expert, Gnanashekhar. We have known each other for very long years. He enjoys tremendous amount of credibility in the commodity market space. And let us hear Gnana what his take is on the base metals market. And Gnana, if you can also touch upon very quickly on the currency factor, because obviously currency does impact metal import and export trade. Where do you see the dollar going, etc.? It'll be very fine. And if you can, Gnana, do it in about, pardon my saying this, about 10 or 15 minutes is okay. But this event may potentially continue beyond 5:30, because I want Chittaranjan to have the full stage as much as possible. Jnana, the floor is yours. Yeah. Audio. Audio.
Yeah, thank you. I think Bharti needs to unmute from her side. That's the reason.
Yes.
Thank you so much, sir. Thank you for inviting me to be a part of this program. As always, you mentored me over the years and I've learned a lot. And it's nice to hear that hear you say that you are still a student and you're learning. That's an understatement, but still, that only shows your ability to learn hasn't stopped even at this level. Thanks to Chintaranjan Rige again, because we've known each other for a very long time, right from his Hindalco days. A wonderful analyst and a trader, now in a different role completely, and doing a great job for MCX. It's good to be back in the same forum with him. Chintaranjan, thank you. Am I allowed to present something, sir?
Okay, please.
Yeah, but what I'll do is I'll quickly summarize what both yourself and Sandeep had just presented, because there's no point elaborating on the same points over and over again. So I can do without the presentation also.
Okay,
but
please. Feel free, whatever is comfortable.
So basically, I have some slides which gives the bullish factors one can look forward to, and the bearish factors that one can look forward to in metals. Since you also told me to keep it brief, I'm just going to touch upon some of the brief factors that I think could potentially have an impact going forward. I'm in absolute sync with what Sandeep says as far as the dollar is concerned, because there's a lot of disappointment that the market is going to face going forward, simply because it's priced in rate cuts too early, number one.
Yes.
And number two, the economic situation, the job numbers, the inflation data, the GDP numbers are all pretty steady and good. And rate cut typically happens when these numbers go bad. And so far, at least, for the next 6 months, there isn't any scope of these numbers going bad at all. So it's just the markets that is pricing. And just because the Fed has paused hiking rates doesn't mean they'll get into a cutting cycle quickly, because it's a big embarrassment for them if they have to again start increasing rates when inflation rises. So I'm absolutely in sync with what Sandeep's expectation is. I think I'm not expecting dollar to underperform at all, or even go down much. Very limited, if at all. They sound dovish because of the U.S. elections. Normally, Fed doesn't have doesn't get influenced by politics, but if it does, and they sound a little bit dovish, it's possible that the dollar index can come down to 100 or thereabouts. That's the closest level that dollar index can fall to. That's a worst case scenario, but it's quite likely that it will continue going up, and therefore I'm not in the camp which believes there will be rate cuts. I think probably even it could extend to the third quarter. I don't think second quarter is what we should expect. And the metal markets also, we have to look at it from the mining companies' perspective, and most of them are finding it tough because prices are languishing at the lows. Of course, barring copper and a few other metals, most metals are languishing at their lows. Post, like Sandeep showed in the chart, post the Russian war, prices have crashed because of lack of demand. And even today, though China seems to be signaling that they're going to be offering stimuluses, it's only doing it indirectly by boosting up the stock markets, giving some relief to real estate and all that stuff. But that's not what the market is expecting. That'll be a disappointment actually for metal markets. There should be direct stimuluses for growth, for infrastructure. That is not seen from China so far. So, that's a disappointment. But having said that, the bullish factor is that the alternative energy space that continues to grow. In fact, surging demand from EVs and renewable energy infrastructure is basically on the other side. You have lack of mine supply issues broadly affecting mining companies. So my point is the response by mining companies will start if prices continue to languish from here as where it is right now. They will start cutting production, and we've already seen that in the case of NiStar and a few other mines, Glencore. They cut production. There's a supply response. As much as we can expect this situation to worsen, dollar to strengthen, I think there's a supply response that is expected, which can turn around metal prices in 2024. Like everyone knows, it's not easy to increase capacities due to environmental issues. So these are my broad bullish factors, but on the bearish side, I think China growth is a key, and any outbreaks could again cause demand concerns. Escalation in geopolitical tensions anywhere is going to lead into demand destruction. And another key factor, which I think most people are ignoring right now, or maybe as we near the US elections, this narrative will build up, I think, is Trump's chances of a victory, which will only lead to more trade wars, between China and the US. That's a huge negative for metals. So in all, if I look at, if I weigh both the bullish and bearish factors, clearly there are some bullish factors holding up the metal markets, especially copper to some extent, aluminum to some extent, but the rest of the metals are all going to be under pressure. That's the message that's clearly coming through. And a bit of one other important thing which I came across and which is very relevant is the China's population that is on the decline, and that's a big negative for consumption story. That is very, very important, and for them to revive this will take another 3 to 4 years for sure, or even 5 years. There's a big negative there. So in all, including the price situation, including the fundamentals, it looks like there are a lot of negatives weighing on metals, and the positives are very less. Therefore, the conclusion is that metals are likely to be depressed, but at the same time, the downside to me is also limited because prices have already fallen so much that the downside could be very, very limited, especially in terms of aluminium, in terms of nickel, in terms of zinc. They look very limited from here. So with that, I think I'll conclude the presentation, and back to you, sir.
Oh, is that all? Oh, thank you very much. That was absolutely brief, but very concise and to the point. Any thoughts on? You said about the dollar, yes, you did mention the dollar index can at best come to 100. Yeah, absolutely, I completely agree. A lot of people can, who were bearish on the dollar are all going to be surprised. Yeah, because the look at the consumer confidence, consumer spending in the US, inflation is nowhere near the targeted 2%, etc. But anyway, okay, awesome. May I now? I have some views on each one of these metals, but I will share only after Chittaranjan finishes his presentation. We are not discussing price outlook, we are only discussing market direction. But I am happy to provide a market direction for at least 4 major base metals. But I think it's time for Chittaranjan to come in and share his thoughts. Chittaranjan, the floor is yours. Chittaranjan, are you there? Bharti, will you unmute him? Okay, I think maybe he's taken a small, possibly bio break or something. I'll go back and I'll share my screen again.
Sorry, sir. Sorry,
uh,
sir. Sorry, sir. I'm extremely
Okay,
sorry.
beta. No worries, no worries. No worries. So what should I do now?
I missed out the query you had. You wanted me to uh, present my case,
Yes, yeah, that's right. But okay, all right. So
or I can wait. I mean, that's not an issue.
so give me 2
I
minutes,
got a
no? Give me 2 minutes,
yes,
Chittaranjan, if you
yes,
don't mind.
yes, yes.
Then the entire floor is yours. 8 minutes from the beginning. I'll just run. Okay. So let me talk very quickly metal wise. My own. I'm not giving any. I'm only giving direction. Obviously, aluminium. There is an issue with Russia because of Western sanctions. But China buys all its aluminium, the material from Russia. This is what, in my view, is keeping the prices in check. And the demand for aluminium from the EV industry, in my view, is sure to help boost aluminium prices over 2024. Therefore, there could potentially be a recovery in aluminium prices by the end of the year, maybe last quarter of 24. Okay, so this is one. Nothing is going to happen in a hurry. Nothing is going to happen in the first half. As I said, it will be a year of two halves. All the price action will most likely happen in the second half. Copper, of course, we know is a metal of electrification. Demand will obviously remain fairly robust, mainly for electric vehicles. Electric vehicles use 4 times more copper than ICE vehicles, internal combustion engine vehicles. And therefore, you can imagine when more electric vehicles are produced and sold, 4 times more copper is used in each vehicle. And then, of course, power grids. Power grids are very, very important for the renewable energy for supply. Therefore, supply outlook, as I said earlier, for copper is somewhat uncertain because of the aging mines in producing countries. Many of the projects, both greenfield and brownfield projects, I expect will slow down in the next 2, 3, 4 years. In fact, I spoke about it in another seminar in Delhi last month, if I remember correctly. More new investments have to flow into copper mining, but I don't see that happening in a big way. And then there'll be a gestation period. And therefore, my view, again, in copper 2024, demand growth will be higher than supply growth. And therefore, again, I think the market has a potential to rise towards the end of the year, last quarter. And this is the last slide of mine. Nickel, you know, your Indonesia is a large producer and exporter, but Indonesia had a 40% increase in production last year. And that is what kept nickel prices so low in 2023. But the point is, Indonesia produces class 2 nickel, whereas LME accepts only class 1 nickel. And therefore, but yet I think it is a matter of time before LME will start accepting even Indonesia's class 2 nickel. Therefore, because of that, I don't see LME inventories rising very soon, which obviously will have a price implication. The last one is zinc. Persistently weak demand because the steel industry, as all of us know, has not been doing well. Steel production has taken a hit because of China factor. Construction industry faced a huge amount of problems, 22 and 23, and then zinc is such an integral part of the construction industry, and therefore, and at the same time, LME stocks in zinc are rising, which again will have a certain price implication. I'm only giving you all the fundamental information. Therefore, I think with this, I will stop and I'll request Chittaranjan to take over. Thanks. Chittaranjan, it's all yours. Yeah, come. Screen share. Yeah.
No, I think now am I audible now?
Yes, sir, you're audible.
Great. Thank you, sir. I couldn't agree more to what Gyan Shekhar was saying about, you claiming yourself to the student of market. I mean, if you are student, then we are in kindergarten, sir. So, this is endless, this thing. But, one of the most interesting part, what you mentioned, what Gyan Shekhar mentioned, and obviously, the good old friend Sandeep mentioned, in terms of making an estimate or making a guess as to what would happen, is a tough task. And we basically want to, tell everybody that, it's very difficult for someone to make a perpetual guess and be right always. Uh, uh, and the choice is either keep doing that or, alternatively look for ways, and which is what our selfish interest as well. But point is, time and again, we feel that, it's the hedging or using the some instruments which can help you mitigate risk could be a great choice. I thought, let me just give brief background to what I think on hedging and perspective. The history of MCX has been that we had contracts which were, cash settled, and I think, the original uh, avatar was the LME prices converted to be in the rupee terms. That set the flavor. But I think, thanks to SEBI, they insisted that we migrate from such pricing to the local pricings, which reflects the domestic demand supply. And frankly speaking, from early 2019 is when we started. I remember our first circular to suggest that aluminum will be a delivery base, which was sometime in the first week of Jan 2019, and March onwards we converted the contract. So last 4 or 5 years has been a great learning, learning from the perspective as to how the physical market, for the subcontinent or for that at a national level, things behaves. At a national level, there are sub-regions. I mean, North is not thinking the way in which South or the East would think. The producers or the sellers in the market, actually want to keep the whole thing segregated, so that, obviously there are transport costs and host of other things which are logically brought into the play when they are trying to sell stuff to their audience. But we took a very cautious call to design the contracts in due consultation with the market forces to rather not further let the market be divided based on regions. And we created a homogeneous structure where, and SEBI was very clear that you can't have a contract which is a single delivery center, and the manufacturing activity is well spread across India. And the raw material requirement for that matter is spread across India. You can't have a single delivery center to begin with. I mean, and claim to be the national benchmark and all of that. So while we started off with a single center and diversified thereafter. So the reason I'm telling you all of this is that we felt that in doing that, we not only got the attention and I would say participation from those entities, but the biggest part was that while we took a hit in terms of the extensive participation what the cash settle contract used to have vis-a-vis today, but I think we are inching in the right direction, because the open interest numbers what we are reflecting in the platform now are far more robust than what it was in 2019. And so what I have done is, instead of probably making it a very mundane routine thing where we say, if you are a buyer, to go and sell, and if you're a seller, you go and buy, and whatnot. I'm rather going to give, simplistic numbers. So while I have shared the PPT with Bharti, but I am going to, try using my own from here. Is that visible, sir?
Yes, it's visible, sir.
Great. So, just to set the context from the point I want to make very simple and straight, that this is a endless cycle. I mean, this commodity doesn't die. I mean, this will not perish. I mean, there are only instances of a portion of zinc which gets into galvanizing and probably will not find its way back into the system in as much quantity as the others would. But I mean, whether it is a brass, which is a copper and zinc combination, and probably it will find its way. But this is the simplest way to say that it's a circular economy. I mean, the mines would have the primary raw material that will go to the refiners. They would refine, send it to the product manufacturer. Product is done. After the product life cycle, it will be recycled and pushed back into the system, and so on and so forth. But what is critical, and which is where I think we want to fill the gap and be useful to the market, is there needs to be a efficient price discovery. There needs to be a platform for hedging, and there should be scope for delivery of last resort. Now, when I say efficient price discovery, and why I made a reference of the regional markets and how those are to be integrated. Now after nearly 5 years of delivering delivery cycles, what we realize clearly is that there will always be a surplus even at a regional level. There is no guarantee that the demand is going to be from all the regions at the same time. The supply, which is not only domestic but also could be possibly from the imports, may not be consistent always or to the same center. And there needs to be a price discovery which will consistently tell the market as to where what has been factored in, and which is reflecting the sentiment of the market at that point in time. Because that's giving a price discovery. So I think whether you want to price benchmark using that discovery, or use it for hedging, is your purpose, your choice. But there is an added advantage when you use MCX. Is it's not only the global metal prices, it is also adding and giving you a discount. I mean, discounted prices when the premiums are part of it, when the duty are part of it, when the currency is part of it. And being a delivered market, I mean, there is any extra overhead cost, one has to take into account that's part. So it's far more holistic compared to dealing only with the LME prices, which my sense is at an individual metal level it will differ. But definitely about when you go abroad, and big portion of the currencies is floating, nearly 12 to 15% of the markup price is where quantity discounts and all of that will again have a play. So instead of leaving it open-ended, I mean, why not to adopt to a benchmark which will give you all of the above. And finally, now that we are a delivery based platform, we believe that there is a scope of delivery as a last resort. Fantastic example, when the pandemic hit, the surpluses by virtue of all the consumers probably went into lock-in for some time, and the producers were left with a lot of surplus that flew into MCX warehouses. The inventory which was on the high seas, once it landed, probably found its way into the MCX warehouses. And at the same time, when the unlocking followed after 2-3 months, and when the shipping lines had a trouble and all of that, the seamlessly this metal itself bridged the gap and found its way into the consumption this thing. So I think pretty early in the stage of delivery based products, when we converted all of that into mid 2019, probably the contracts were not even a year old when the pandemic struck, and there was a clear value proposition which we brought to the table, and thanks to the industry which adopted to it pretty fast, that prompted us to actually expand our warehouse footing as well. So I have a slide which will give you precise perspective as to where we are. So we now are present east, west, north, south, to ensure if there is surplus anywhere, that can be monetized by delivering on the exchanges. Just keeping it simple and straight, in terms of, I mean, we can endlessly debate whether the prices are going up or going down, but regardless of the direction, the volatility seems to be a constant feature. And this is the rough estimate or giving you, of how the history of volatility has been on the MCX aluminum. So for that matter, between 2016 to 2019, 18, 19, probably we can say that this was the cash settle time, but the all double digit numbers, and thereafter 2019, which was a conversion year for us, and thereafter followed by 2 consecutive years of the pandemic and the supply side troubles and whatnot. So look at these numbers. I mean, these are all double digit and probably north of beyond. I mean, aluminum, which is supposed to be the least volatile, as I'm told. But the numbers are pretty steep, and which means that in case if the volatile, a commodity is part of your balance sheet or that's your work profile, it can, while we keep guessing as to where the price direction would be, but the volatility may eat away a lot of the margins in the business. If you're lucky enough, probably it will give you a lot of bounties. If you are unlucky, and because when it adversely hit, you will find no takers for giving you the subsidies which you otherwise did not budget for. So we believe that it is important that as a practice, as a habit, as a discipline, you should get adopted to hedging. I mean, you may start with portions of it, percentages of it, but eventually, this. I mean, I find that the corporates have adopted to the currency hedging in a far more greater proportion than what they have for the commodities, and I see a great scope in doing that. And there are enough reasons for for why they need to adopt for it. So giving this simple example of aluminum, I believe there is a case for people to choose hedging over keeping it open ended. While I think Gyanshekhar Saab and Sandeep and Chandrasekhar Saab all have already given this thing, but this is a precise summary. And the reason I am re-emphasizing, not to really elaborate as to what economic events would be or what commodity specific cycles are or trade policies or the INR, but my essential pitch is to tell you that a sum product or a cumulative impact of all of this is reflecting on the MCX prices. So you don't have to, when if every time you look at the MCX screen, I think it will give you a very good idea of where anything is right or wrong or going up or going down. It is factored into this price, and based on that, you can do the estimates accordingly. So I do not want to dwell too much into this, but these are the constant features which will always remain. Trade policies, the exchange rates and whatnot. But I believe that it is important that one adopts to a standard benchmarking module. If the benchmarking reference this thing is domestic, then rest of the other things, including the currency and the premiums and the local freight and all of that will be taken care of. And more and more, the settlement cycles we go through, we realize that the industry is adopting, the trade is adopting, and as long as the bilateral trades are happening basis MCX plus minus, it's a great achievement we feel has been done so far. My feeling is that whatever legwork we have done so far has been a primary metal oriented. We are already working on how we can bring in the recycled or the value added products into the fold. And once that is incrementally brought into the platform, I think it will offer a unique combination of the price discovery of the raw material and also the end use if it is not being sourced only from the primary metal. So like aluminum alloy, or for that matter copper CC rods, will be interesting products we feel, because aluminum alloy, I'm told, is a product made out of the scrap, and the primary metal is used more for a blend which is not in great proportion. But yes, so the pricing is more scrap oriented than the primary one. But having after if we are able to list this product with the blessings and the approvals of SEBI, it will be great opportunity for the industry to really have a unbiased and a transparent view on how the primary markets are behaving and pricing themselves, and how the secondary or the alloy markets are working. Now, in terms of entitlement, this is simplistically saying that, you please, I mean, you could be in any of this, importer, exporters, processors, unless you are only into job work, wherein, you only get remunerated for the effort you put in or the quantity you churn. Everything else is where you carry the risk, and if you are carrying the risk, might as well. I mean, obviously a lot of the trading, fraternity people are of the opinion that taking that time, differential, or the time that risk during that time is where the reward lies. But you're absolutely right. I mean, we take that point, but at the same time, the markets are not unidirectional for you to be always buying low and selling high, or vice versa. But some portion of hedging would bring stability to the uncertainty, otherwise, which would hit if you remain unhedged. So, and I'm sure that, the clients, or, people attending this session would find their, they being part of any of this. And even if you're buying locally and selling locally, I am sure that the directly or indirectly, the price, which is, while it is being discovered locally, but impacted from the global factors, would find, not only you will be able to identify, probably benchmark, and have a precise solution, which is, we transact, we operate from morning 9 a.m. to 11:30. So it's not that any particular region is where, the demand supply imbalances, the currency impact, the interest rate changes, all of that is happening. There is constant price discovery, which is, we're working, and that will help people to instantly react and address if there are adverse, price movements happening, to keep the margins intact. Now, when I say, as to, we've been doing pretty okay, but, in terms of numbers, this is the reality of today. On an average, we've been trading close to about 12,000 tons of aluminium in this financial year. That number used to be pretty steep. Last year, we were close to about 31,500 tons. Copper currently is about 15,000 tons, lead about 3,500 tons, and zinc close to about 26,000 tons. Of the average volume, what we transact on our platform between 9:30 to 11:30 every day, let's say, somewhere close to about 248 or 247 working days. These numbers are essentially reflecting that, how robust or how widespread the participation is. Now, what I also mentioned briefly at the end was the last. I will try to seek your attention to the last, last three columns, which is the open interest. Now, I mean, you look at the way in which the open interest has substantially improved, with the metal flowing into the multiple warehouses spread across regions. The aluminium and the zinc, and, for that matter, copper as well, or lead as well. I find there are takers, and people are finding it useful to, hedge, and probably if the unsold inventory is there, then they would offload it on MCX. So the quantum improvement in aluminium and zinc, particularly in this year, aluminium last year, and consistently on on copper, has been very encouraging. We believe that physical market, needs to probably use this contract more often to hedge, and the sellers and the people who have surplus, or the producers, can actually deliver in at, just in time, if they feel the inventories are unsold, or they cannot export. But I believe delivering into the domestic exchanges is a great idea. As to what can be delivered and price discovery is happening for which metal precisely, this basically aimed at that. So on aluminium, it's the primary aluminium. The primary aluminium ingots, the small ingot, what the trade says, is the primary base grade. We also facilitate deliveries of SOs and T-bars, for that matter. On copper, it is cathodes. Nickel, it is cathodes. For lead and zinc, again, these are ingots. an interesting phenomena now is that we have done away, I mean, with the LME grade of 99.97% minimum lead, and we have migrated us, to the domestic grade, which is 99.98% purity, which is BIS empaneled now, and we also undertake a lot of empanelment of the domestic refiners into MCX, very akin to what has been the practice internationally, what LME has been doing for so long, to approve or accredit the brands which can be delivered against the seller's obligation on the same lines. This is to really summarize this thing. So on aluminium, zinc, and lead, the regular contract is 5 tons each. For these three, we also have a mini contract of 1 ton each. Copper is 2.5 tons and nickel is 1.5 tons size. The quotation value, what you see on screen on any given day, is rupees per kg. It is without GST. So everything including. So it is LME, it is premium, it is currency, it is the exchange rate, the customs duty, and everything is factored into this. And so is the reason I am very, very motivated to keep repeating that benchmark and reference these prices for your own consumption at any purchase, any sale, any value addition purpose. For aluminium, which used to be a Thane delivery center earlier, when it was a single delivery center, then we migrated it to Raipur, from where accessing the local supplies is far more easier. So whether the Balco from Chhattisgarh or Aditya Aluminium, Vedanta, or Nalco from Odisha find it very convenient to deliver into Raipur warehouses, because even otherwise the redistribution of metal can happen from this place for all the regions. So the buyers find comfort. They do not have to really incur additional expenses on the transport. Has been quite a boon for us. Copper, zinc, nickel, the primary delivery center is Thane near Mumbai, and on lead it is Chennai. The only nickel has the minimum tick size, which is the price change which can happen is 10 paisa, but otherwise everything is 5 paise. There is no mismatch in the trading lot and delivery lot of the contract. So if aluminium is 5 ton contract, it's a 5 ton one has to deliver with a tolerance of 10%. Now, tolerance essentially is to ensure that there is, you cannot have a precise number of the weight. The weight tolerance has to be provided for, and we have given 10% to begin with, but I think it is far, far lesser for whenever the deliveries happen. Lesser tolerance. So, I mean, my guess is that a fair estimate is between 5 to 6% is where the tolerance is lies, but we haven't changed it, other than for lead, which used to be 15% earlier. We brought it down to 10% nearly about a year back, and it's been holding on to that. So on aluminium, the deliverable shapes are ingots, sows, and T-bars. So sows and T-bars got added only around mid of 2021 or late 2021, when we also added Raipur as a delivery center. And it's both of these shapes are at a discount to ingot, which is at 1 rupee per kg. The mini contract of aluminium doesn't have a provision for sows and T-bars to be delivered. It is only a precise ingot contract, and there is no such variety or multiple shapes or grades being delivered on any other metal. So the price discovery is unique, and people can refer to it. So when it comes to delivery centers, as I told you, I mean, the aluminium has got the maximum, because Raipur being the primary delivery center, we have the presence in east, west, north, south, and has been the case with rest. Rest are present east, west, north, south. So Thane in west, Palwal, which is part of Haryana and also part of NCR, is the sole representative for the north. Chennai down south, and Calcutta in east. That's how the combination for the base metals has been. We haven't seen inflow of metal for copper and nickel anywhere else. They have always been delivered at Thane. I mean, that's how the market, there is no price incentive, either a premium or a discount we have on the delivery centers. So it becomes delivery of last resort and the choice for the seller where it is cheapest to deliver. So Obviously, for copper and nickel, it seems that Thane has been the cheapest to deliver location. We have seen delivery of aluminium practically at all locations. Consistent flow of goods at Raipur, unabated. There has been inflow of, decent quantity in Calcutta, not as much in Thane now, and some bit in Palwal for that matter. And same is the case with lead. I mean, lead is the one where, Calcutta never has, received metal so far, but consistent deliveries in Chennai, in Thane and Palwal. And with more and more brands getting approved by MCX on the refined lead side, I think the supply will only improve across the board. On zinc, we see regular inflow at Thane and same in Calcutta. Not as much in Palwal or Chennai at the moment, but definitely in last settlement cycle, we saw some decent inflow coming to the Palwal warehouse as well. The Calcutta, or I would say East, happens to be a big consumer of steel, and consequently, they also big producer of steel, and consequently, they are big consumer of zinc for galvanizing purpose. So there is a natural, requirement that side, but the big clients, and I think big, I'm sure the domestic producers address their requirements pretty well. But I mean, now every now and then we keep seeing merchant quantities getting delivered there on a regular basis, and it's had been a regular feature ever since we added Calcutta as a delivery center to our contracts. One of the other things which SEBI wants us to do, I mean, this is part of our mechanism, so I briefly touch upon this, is we procure the spot prices in the market every day at around, between 3:30 to 4:30 from the people who are empaneled with us, have to be from the physical trade and who have a good guess, good estimate of what is the prevailing price right now. So what can happen on screen is futuristic. It has got its own settlement date. But at that point in time, it has to merge with the spot market, and so I mean, people from the trade, we encourage that you should empanel with us so that the price discovery or the settlement cycle would work smooth. Unlike LME, we have, our contracts are very identical, designed very identical to how the equity markets in India are. The month end is where the settlement cycle or the expiry is. The last 5 working days of the month is when the delivery period is start. We call it staggered delivery period. Each day there is a settlement cycle which follows. The sellers give intention. Thereafter, those are marked the next day, and the buyer, we collect money from the buyers the next day and give the credit to the inventory to the seller, and money to the inventory to the buyers, and money to the sellers. And then next 3-4 days, the GST settlement cycle also happens, and thereafter one can remat the warehouse receipt and take the goods out if need be. Otherwise, goods can be held into our warehouses for whatever times the owner wants. And we anyways bill the rents on the warehouses on a pro rata per day basis. So that's not a problem as to how long one would like to hold the goods. In terms, when we say that there is a provision, penal provisions, if the defaults happen, then, on the seller default, if the seller is unable to deliver the required goods at any point in time, then there is a provision for penalty, which is 3% of the settlement price and the replacement cost. When I say settlement price is whatever is the on the first 4 days. So, the first 4 days of the settlement price, the closing price of MCX becomes the settlement price, and that becomes the price at which the GST and every other calculation also works. So that price, 3% of that becomes the penalty for the seller. 1% of that, goes to the buyer, 0.25% retained by the exchange for the administrative purpose, and 1.75 goes into the settlement guarantee fund. And the replacement cost is that the spot price in the next 2 days, and whichever is the higher, that price versus the settlement price, whichever is higher, that also is remunerated to the buyer. So the penalty is not limited to 3%, it is also the replacement cost, because we have, the system has the seller has left the buyer high and dry without the inventory. So when he goes out in the market to procure that, he has to make good for the price difference as well. So while it seems very elementary, but it's important to realize that if you are on the exchange, there is there is scope for you to get rewarded for even if the seller default, there is enough financial remuneration for you to go and pick up stuff from the open market. We are a futures exchange, so we margin our trades, and we significantly margin. Typically we are double-digit margins to begin with. We also collect the MTM margins on a regular basis. And by the time the delivery period comes, we also incrementally charge 5% incremental to both buyers and sellers unless the delivery is marked. So practically speaking, we have close to about 30-35% in terms of margins with us. And we believe that there is no scope for the buyers to default. We will debit all the brokers to ensure that 100% of the value is with us, so that the seller is able to dispose goods in totality. This is just a brief glimpse. Probably, we are a couple of slides away from my PPT to get over. Just to illustrate that how much of quantity got settled via the MCX clearing in the last calendar year. Aluminum numbers are fantastic, close to in excess of 31,500 tons. Copper close to about 19 and 20,000 tons. On zinc again 31,000 plus. Lead 8,000, 8,500. Nickel currently is dead. We are hoping few suggestions we have submitted to the regulator, and I hope they allow and we are able to make changes into our contracts, and accordingly we'll try to improvise. So a final number, since we converted the contracts to a delivery cycle, the quantities which have gone via settlement are in excess of 364,000 tons, which is quite an encouraging number. And month-wise delivery for the entire financial year aggregated number for the calendar year 2023 was 91,580, which is greater improvement over the last. We being futures market, as I mentioned you, we expect as SEBI has been prescribing that there are accessing the organized markets has to be a disciplined feature. Work via the registered members. When we say members of the exchange are the brokers via whom the clients come and participate. The KYC is important. Read, refer, make sure that your own mobile number is registered. The details, nowadays, I mean, there's a fantastic facilities which brokers have come up to for you to participate and transact via. There are a host of, the reports you can download and keep referring as to what's happening to the overall trade transactions, what you have done. I mean, there are tips and host of other things which anyways will remain part and parcel of the every market. Resist, that's what has been the message. And there is a dedicated investor website which SEBI has now, investor.sebi.gov.in, where all of these things threadbare has been explained in great detail as to how you should do and how you should transact. Now, while this one is already covered, by even Bharti and Chandrasekhar Saab initially, so I don't want to dwell too much into it. But in case if there are queries and this thing, I'm sure this copy of PPT is already with Bharti. She would be able to circulate this thing to the audience, all those who have attended. While I'm done with my presentation, but the final message which I want to give is that whenever you transact in any of the metals which are listed on the exchange, please use this as a benchmark to decide, estimate budget, or when you want to participate in tenders and all of that, because this is now getting deeply rooted into the Indian price discovery, and it will help you not only to estimate, but also to ensure that if you want to subscribe to a local hedging mechanism, this is where it is possible to be done. So Chandrasekhar Saab, thank you very much for the opportunity. Happy to answer any queries you may have.
All right. Thank you. Thank you, Chittaranjan, as always. Wonderful presentation. very precise. You've just captured all that MCX is doing to promote this base metals market, derivatives market, deepen and widen the market. I'm sure the results are seen, as we can see, a higher open interest, etc., etc. And it's a process. Nothing is achieved overnight. So education, training, awareness, that's the way forward. Anyway, very interesting. Thank you very much. I'm not sure if we have time for any questions. My request is to Sandeep and Gnanashekar and to Chittaranjan, if you post your, and of course to Bharti, if you post your email ID in the chat box, those who want to engage offline can write to all of you. And if there are questions, maybe we'll respond to those questions. Sandeep, are you there? Will you post in the chat box your email ID? Same with
Yeah, I'm doing
Anna?
that, sir.
Yeah.
I'm doing. So should I
There
send
will
it
be-
to Bharti or should I send it
No,
to
just
everyone?
your ID, post it in the chat box here. Bharti will save the chat box. And let me also mention, normally what happens is nobody hedges 100% of the production or 100% of the consumption. In a rising market, the producer typically hedges only ballpark number 50% of production. In a falling market, the consumer hedges only 50% of its production. But the point I want to make is this market, this derivatives market, is not only for hedging, but it is also for investment. You can actually trade these commodity contracts, become an investor. You don't have to give delivery or take delivery, but if you take the right calls, if you have the right bets in terms of a price increase or price decrease, there is actually money to be made through investments. So this is important. The second message I want to give to this house is that in India, we always felt we are all comfortable investing in a rising market. I buy something today, wait for prices to rise tomorrow or day after, sell and make money. It is actually a no-brainer because our economy is in an expansionary phase. Prices will keep rising, but more money is usually made in a falling market. To play a falling market, to play a bear market, you need enormous amounts of courage and enormous and deep knowledge to play a bear market. And all those people who are super rich, who have played these markets, equity market or commodities, have all made money in actually a bear market. And therefore, I think there are opportunities. And therefore, I think we need to learn where those opportunities are. So I think with this, please allow me to conclude this webinar. Thank you very much. I want to thank, of course, all the participants first for being with us. I hope it's been quite educative. I want to thank Sandeep Daga for his very wonderful presentation, Gnanashekar, always supporting our events, and of course, Chittaranjan, who brings a breath of fresh air in his presentation, not the staid old presentations we've been making over the last 2 decades. So with this, I also want to thank IMC Bharti Salunke for coordinating this, IMC's IT team for supporting this event. Good luck. God bless you all. Take care. I'm sure we'll be doing these events more and more from time to time. Wait for IMC circular about our next event, IMC MCX joint event. Thank you very much. God bless. Let me conclude now, and that's it. Thank you very much. Yeah.